So it's good to know. So here's kind of the explanation of the practice exam. The first calculations here are for the 100% ownership. And what I want to kind of draw your attention to is, here we have the net book value. And down here is the net assets identifiable at fair value. So what I've done is the excess assets that are for the equipment and the patents, if you add those into the book value, they will be the same as that net as identifiable assets at fair value. So that's kind of how, they, and the reason I bring this up is that it really depends on what information they give you. And they might give you the book value, and they might give you something that looks like this. They don't give you the fair values, but they'll tell you what the excess assets are. And so you can get to that number, you have it. Another thing they might do is this. Still see what those are, but they don't give you this, and they don't tell you what the book values are. And that's going to come into a little bit of importance when we get into some of the stuff today, but I'll explain that. By the way, here on out, we're going to do 100%, and I usually show it this way with the fair values and the excess assets. But and then down here is just how we split it up. I don't think people had too much problem with that. But this showing up, there we go. Yeah, so they can show it to you a few different ways, and I show it both ways because that's the way some of the problems in the book were. A lot of these problems that we actually have, I had a question about, when we have textbook problems. A lot of these problems that I have in the handouts are basically the textbook problems that are cleaned up a little bit. Any questions on that? That's due this Friday. If some of you have already turned it in, but if you haven't, it's not due till this Friday anyways. And another thing I want to talk about is when you do turn in an assignment, for all assignments, you can turn in more than one. So if you turn in the wrong thing, or if you turn it in and you don't get all the points and you finish it or whatever, all you got to do is submit again. And again, you can have 3 or 4 submittals and it doesn't matter. And I usually go to the last one first. Now, when it comes to the exams, I usually wait and don't grade those until they're due. I'll probably, some of you, I already turned it in. I should have put the due date this week. I'll go ahead and this Friday, hopefully once you have them in, that you can actually take a look at them. That I'll take a look at them and get your grade in. But anyway, up until I put a grade on it, you can turn it in again. So you can only turn the exam in once it's graded. So if I haven't graded it, you can submit another one. And again, you don't have to, contact me and say to, free up the account or whatever. It's just, you just submit it and it'll go in as a second submittal. Question on that? Okay. Let's get it. I think we were working on chapter 2. Uh-oh. Where's my handout? Did we start in chapter 2?
Yes, we started. And we stop at the question number 6.
How come it's gone from my? Maybe I did it right in the handout. Did I not save it as a W? No, I have to. Well, I don't know what I did with mine.
Question, Professor, I did have a question about number 5. I just want to make sure I had the calculations correct. But we stopped at number 6 for chapter 2.
Did we do number 5 already or no?
We did. I just want to make sure my calculations.
Okay. Well, let's see here. So let's say our net assets at fair value would be. We talk about identifiable assets. So 150. And we paid, oh, it was 130. So this is a bargain purchase, right?
Yep, of 22.
Well, paid, they call this consideration sometimes. That's a legal term. Oops. How much will we recognize? None. Bargain purchase. We got 150,000 worth of stuff for 132,000. So the bargain purchase is 18. 150,000 worth of stuff. Back in my day, they used to call this negative goodwill, but now it's a bargain purchase, and really is a bargain purchase. So it's okay. So it's dissolved. And we kind of lump the current assets together for this one just to make it a little easier. Land, building equipment. I wonder what happened to my one I did last time. You know what? I'm gonna, before I go on, I'm gonna save this, make sure. Save it. Okay, 45, 15, 140. $70. And we pick up the liabilities, accounts payable and loans payable.
So it's 18, not 22?
Yeah, because so we're gonna take the, so the assets are positive, those are, and this is what we have to pay off. So I think it's 150, right? I think it's 150. So this is what the net asset, the identifiable assets are at fair value. And we only paid 132, so the difference between those two, 18. So this would be 35,000, 85,000. And let's see, so we paid out, was this cash? Cash.
Professor, we did this some that day at the last class.
What happened?
We already did that.
Yeah, yeah,
I mean, to be honest, I did not show.
well, I don't have it either.
Yeah, and I was just trying to make sure that I have the answers right. So I don't, can you please go over it just so we can make sure that the answer is correct?
Yeah, so this is it.
Because
So
my
this is,
answer didn't balance at the end.
let's see, they should, let me see, well, actually. It should be what, 270? If we add these up, these should also come up to 270. Yeah. Yeah, well, this is the weird one because this is the bargain purchase. And I think I mentioned this last time. This is one of those, this is fairly new. I think it's like 5 years old now or something. But it's fairly new that we used to never recognize a gain on a purchase. You only recognize a gain on a sale. But this is one of those weird circumstances where we actually recognize it on a purchase. And I'll tell you why. In the past, we used to take this 18,000 and subtract it out of these assets. But there's a problem with that too, because now these assets are misstated. And it's very hard to know how well management's doing because these are misstated too low, these assets. So that's why I believe I'd have to read about it, what the reasoning is, but that's why we
How did
recognize.
you- Professor, how did you get 70,000 for equipment? I just want to, I have everything else correct. I just wanted to know, how did you get 70,000 for equipment?
Here. Yeah, so we're gonna put all these on at the fair value. And again, that, when you buy something, it's what the fair value is, not necessarily what they paid for it. So even though they paid, yeah, how come that didn't bolt? Even though they only paid 50,000 for the equipment, if it's worth 70,000, when they sell it to us, it's gonna be 70,000. You especially see this with buildings very often, buildings and land. Sometimes people get land for $2 an acre, now it's, 80,000 an acre or something like that, but, in the US rules, we leave everything on at what we paid for it. And while that's good because it's verifiable, what is bad about it is sometimes you end up with nonsense numbers. These aren't so bad though. These are soft by 20,000. Yeah, so these all go on. You actually bring up a good point. These all go on at the fair value. So these are
Thank
gonna all be fair value. And even if we do have, goodwill, it's basically what we call the fair value. And the idea is that the reason we're paying more for it is that, it would be, that there's some reason why we're paying more for it. It's not just a fluke. There have been people who have noted though that when people talk about goodwill, they say, well, goodwill comes about when you pay too much for something, and bad will comes about when you get a good deal. Almost we should reverse the terminology of them, but. Okay, let's go to. Did we do number 6 or no? No, we didn't. Okay, number 6 is a little bit different. And it has to do with shares of stock. And basically, what happens a lot of times in mergers is that having enough cash to buy out another competitor, especially if they're a very large competitor, it's very difficult. So what they end up doing is whoever's buying out the other company, they will give them shares of their stock. And that those new shares of stock will cover both companies. And this is very common when you see big, large mergers. You'll see one company come in and buy up another company. Instead of giving cash, which they probably don't have, they probably don't have like 35 billion in cash, but they can issue 35 billion in shares of stock. And so you end up with this really big company that has these many more shareholders, that the shareholders are basically from the two companies and they're combined. So it's very common to use common stock, not for small companies like this, but especially for large companies, it's very common to use common stock to do the mergers. Okay, so let's take a look here. So they issued 500 shares of common stock with a $5 par value. So $5 is what the minimum we could sell the stock for, but the stock is trading at 27. Gotta get this out of here. Move, you, move. It moves when I stop. All right. So this is the value of the shares that we're giving them. And this is what we're getting back. Net assets, these will be identifiable. At fair value. All right, so 165 minus 45 is yeah, 120. Yep. Right. Oops, one more zero. No, it's right. Okay. All right, so this is what we're giving them. And or scratch that. That's what we're buying from them. What we're giving them are shares of stock. And we're giving them 5,000 of them. And the value of those shares is $27. And so this is the consideration. And let me put it somewhere else. Put it over here. $5,000 times 27. 135,000. Did we already do this? We didn't, did we?
$135.
Okay, so in this case now, okay, so here's the identifiable assets, 120. Here's what we gave them, 135,000. How much goodwill will be recognized? Yep. Oops. So we're gonna have 15,000. Now we're really not gonna do anything with the 15,000 because it doesn't get depreciated or anything. It just sits there. This building, we're going to have to depreciate that at some point in the future. But we're just gonna put this on the books. Now, here's the wacky thing when we get to the journal entry for this one. This is when it's not dissolved. We're going to keep this as a separate company. This is an investment. So notice up here, we dissolved the company. We took all their assets and their liabilities, put it on the books, right? Because this company is no longer there. The Bengals Corporation is no longer there. Okay, coming down here, well, same Bengals Corporation. I got to get different names for these. This is not dissolved. So here's how this would look like. We would have an investment on our books for what we gave them. Now, you can put this on either investment consolidated, but usually it's put on at even a consolidated entries, they use the equity method for it. They'll virtually always use the equity method. So the consolidated is often just the equity method. Oops. Spelled correctly instead of the way I spelled it. They're going to use the equity method on this event. So here's what it's going to look like. We're taking that entire company, putting it on the books as if it's an investment. We're not dissolving it. It's separate from our company. So this will be the journal entry for it. We'll have to make, oops. Let's make the journal entry for the stock, and the stock will look like this. What was the par value? 5. So the stock goes on the books at the par value. So 5,000 shares, so it'll look like this, common stock. I'm going to put the calculations down in the second row here. We have 5,000 shares times a $5 par value. $25,000. Now, there is an additional amount above the par value that we have to take into account. The par value is kind of weird. Here's because I wish we didn't account for the par value. Some states require it, some states don't. Par value is a minimum amount that you can sell stock for. It's a minimum amount. You can sell it for more. So if we have a par value of $5, we can sell it for $5, but we can sell it for more. And oftentimes these are sold for more and much more than the par value. And we call that additional paid-in capital. So additional paid-in capital is the amount above the par value. How much is it above the par value? Okay, so you guys probably went through this in your other accounting classes, but so additional paid-in capital. Oops. And you can abbreviate this APIC. You'll often see this called. Don't do that. What is that? And APIC just stands for additional paid-in capital. So it's how much over the par value. Okay, so we will take 5,000 times the additional over the par value. What is it? So it's 27,000? No, $27. I'm sorry, $27 minus the par. Oops. Gotta clean this up. Okay. So what this comes out, so this will look like this. So it'll be 5,000. 27 minus 5 is what, 22? This doesn't let me move it. Come on, move. Um. So the 27, the fair value of the stock, so 5,022 is what, 110? And that balances. So these are the journal entries for it. And so that's going to be and it just sits in our investment account. Now, I'm going to show you what happens with it after we put it in the investment account, because at some point when we make our financial statements, we're going to consolidate these. So these will be consolidated with the other ones, and I'll show you how we do that in a little bit here. But notice the difference though between these is how we do the assets. If we're not going to dissolve it, we don't do this. We don't put all the land and building equipment and all that stuff on the books. We simply put it on as investment. It's separate from our company. You know, we don't have their equipment, their building and all that kind of stuff. We're carrying it as a separate investment.
So then you don't do anything to record or notate the gain?
You will, for this next one, yeah, we're gonna have I think we have a gain on this one, right? Yeah, let's jump to the next one. You would record a gain on, well, let me do something here. You would account for like the income and all that the same way we do the equity method.
Yes, so when we will write the fair value amount, and also we will add a goodwill in a debit side, then the credit and the debit will be matched.
Well, actually, here's the thing, the goodwill is locked up in that investment account. It's in there. There's 15,000 of goodwill in there. It includes that 15,000. And what we're going to find is when we do our consolidation, that goodwill will come out of it. We will put it on the books eventually. But initially, when we first buy it, it just goes on as an investment.
But if we will add common stock and additional paid capital, it will be our investment, which is 135,000.
Yep.
So
Now remember though, there's that goodwill has, you know, it has the identifiable assets in there. You know, it has the identifiable assets, but it also has this unidentified asset of goodwill. So those are both in that 135,000. So this is an asset. The term unidentified is kind of wacky because it is it's goodwill, it's identified. But I know what they're talking about though, that they're saying that, you know, what are the ones that you can actually put a value on that are on the books. And anything above that is going to be goodwill. But anyway, this is, so we identified 120 of assets that they have on their books. But here's the thing about goodwill, and you might say, well, how come they don't have goodwill on their books? They don't have goodwill on their books because they can't. You cannot put goodwill on the books even though you have it. So for instance, McDonald's, the name McDonald's is worth loads, but they cannot carry that on the books, the goodwill of their name, because it's internally generated. So they'll still keep all their other stuff on the books, but the name will be separate, the goodwill. They won't have any goodwill for that.
we don't have to write all the current assets and liabilities in that.
Nope, everything is in this investment account. All,
Okay.
so this includes all assets, all purchased assets and liabilities.
Okay.
And yeah, it is kind of strange, but it's just like a any kind of other investment. Now, there is an exception on the second one here. Wouldn't you know it? Oops. So everything is included in that investment account, everything. The identified assets and the goodwill, they're all in there. All right, let's go to the second one here. Very similar. In fact, strikingly similar. So similar, I'm going to cut and paste. Okay. So let me copy this down here. Part of my teaching how to be lazy again. Very important skill. All right. So same as the one before, they have the fair value of 120,000. However, they're saying, what if the fair value of the stock was only $23? Oops. That's so goofy. Okay, so the shares of stock, instead of being $27, they're only 23. So I'm going to change this to 23. And let me make that a different color. Let's make that green, how about, so that we know it's different than the other one. So if the stock was only worth $23 a share, what is that? Some number, 5,000 times 23. Yep. So now we got $120,000 worth of stuff. We paid $115 for it. So what's that going to be? It would be 5,000, and what we're going to call it? Yep, we bargain purchase. So this will be. So this will be our bargain purchase. Now, we're going to put the value of the stuff we have on the books in that investment account. So we're going to put the fair value of that on the books. We're going to recognize this gain. This will be a one-time deal. We'll only recognize it the first year. You know, if we have this company for 50 years, only the first year will we have that gain. So it'll look like this. So this is where it gets to be a little bit wacky. We have 120,000 worth of identifiable assets. We're going to put that on the books as the investment. Oops. Okay, we're going to put the stock on that part. Oops. Put the common stock. We'll put it on a par value. Be the same as before. 5,000 shares. How did I word that before? Okay, same 25,000. The additional paid in capital, you'll see this often called APIC. I've seen financial statements that just have APIC listed on it. Ones they give out to the to everybody. They don't even bother to um, Again, you can just, you can feel free to abbreviate that as APIC. Additional paid in capital, so we have 5,000. Times the amount over the par value, which is 23 minus the 5. Yep, 18. So this will be 5,000 times 18. Yeah,
Difference will be the bargain. Or
Yes.
investment should be for that.
no, you're right. It's the bargain purchase. So let me do something here. So these are what we're gonna put on the books. And 5,000 times 80 was at 90,000. And you'll notice these two sides don't add up. This will add up to 120. This only adds up to 115, which is what we gave them. And this bargain purchase will be the other.
We did not take goodwill in the last question. We are taking bargain purchase only.
The bargain purchase will be put out separately. Yeah, so you're exactly right. The goodwill will be included with the assets. The bargain purchase is taken out and recognized only in this year. It's just the rules. In the past, what we would do, in the past, we would write up these accounts. And this is one of the reasons why they don't like it, you know, we wouldn't write them up, we'd write down these accounts. And one of the reasons I didn't like it is that, you know, you would be changing the fair values, you're messing up these accounts. And by the way, if you did that, the company would look more profitable than they really are going into the future. Because it looked like they had fewer assets and yet they had the same sales as greater assets.
In that they were not like in terms of money, but in terms of fair value. They are having loss, that's why they are showing loss, but in that they were having profit.
That is one way to think about it, yeah. Because the bargain purchase. And if you think about it, like a bargain purchase, you're getting more for, let's just say gain on bargain purchase. So we got 5,000, is it 5,000? I think it's 5,000. Yeah, remember it's 5,000. So this will be 5,000. So we got 5,000 more. We recognize that immediately. So the first year we recognize that 5,000, we never recognize it again, the bargain purchase. And this investment goes on our books at 120,000. And now here's the thing, when we do our consolidations, what we're going to do is add these fair values, which will come out to the 120,000 onto the books. So these will come out to 120,000. Oh boy, look at this. All right. Good. Hopefully this one will, we're gonna do our first consolidation. Now, I want you to look, so Amy's company bought Bill's company. And I just messed up the spacing, I'll go back. Okay, Amy company just bought Bill company. Now, I want you to show you something though. Amy company has Bill company on the books for 96,000. So notice if we just took the two companies and smashed their assets together, you know, add their cash, add the receivables, add all this blah, blah, blah. we would actually be counting bills twice because this investment is actually the bill company. You know, this is the bill company. So if we were to just add both of these together and include that investment, we'd be counting bill twice. We'd have all Bill's assets and liabilities, and we'd also have this investment, which is Bill's company. So what we have to do is what we call eliminating entries. We're going to eliminate this investment account. And this is so we can show a consolidated financial statement that has both of the, you know, all of the cash, all the receivables for both companies, all the inventory for both companies. This will be a consolidated financial statement. However, we have to take off this investment because this is the same as the bill company. So, you know, bill company, we put it on the books correctly at we must have given 9,600. Some cash price paid 9,600. Okay. So this is right after we made this purchase of Bill's company. We're going to put this on the books as of the first day of the company. So we're going to do a consolidation on the first day. Usually you wait till the last day of the year, but for fun, we're going to do the first day. Okay, so we're going to have to do some, you know, moving around here a little bit to get the to get these to balance, you know, to get the two companies to balance out and to not have Bill counted twice. Okay, I'm going to go up to the beginning or last. I think it's the beginning. I think it's page 2. So in this chapter, these are the two we're going to cover. Let's try something different. We're going to do eliminating entries for S, which stands for stock, and A, which stands for assets. So I'm gonna copy these. I'm gonna bring these down with us. I'll put them down here. Oh, well. Okay, so let's kind of get a feeling for what this is. Now, these are the assets at the fair values. Okay, so let's take a look. So right after we do the journal entry, we have the cash 96, the receivables 720. So that's what those are. 4,080, 3,360. Those are different. I thought I had these already calculated out. All right, let's put the excess assets over here. I actually thought I had these set up as a second row. All right, so cash is the same. We don't do any, there's no excess assets there. Inventory, receivables are the same. Inventory, the fair value inventory is 4,080. The book value of it is 3,840. Copy that. 40. Land 3360. How are you doing these so fast? What'd you come up with?
40.
Did I get this right? Wait, 280. Land 2880. Okay. I'm sorry, one more time, what'd you say it was?
480.
480, I'm sorry. Yes, and our building.
$720.
720, thank you. Okay, so these are gonna be the excess assets that we're gonna have. And by the way, we can see what the value of this company was worth when we bought it. It'll be this 13,920 minus these accounts payable. Oh, for both, okay. So it's not, it's exactly what we paid for. Let's just say at fair value. Oops. Okay, so bonds, the total. I'm just gonna abbreviate this as fair value, if you don't mind. So 4,320. So 13,920 minus. So the assets are the good stuff and the liabilities are the bad stuff, and so that's how we got that. So is there any goodwill in this? No, we paid exactly what it's worth. No goodwill. Okay, so let's take a look here. So coming down here, all right, let's start doing some of these calculations. Try to get some space here. Okay. All right. So far we're gonna do the S and the A. So we have to remove all the stock stuff from the subsidiary. Okay, so we're gonna make a note here. So let's see, we have this they have common stock and additional paid in capital. So I'm gonna put a S there. I wonder if I can bold all this. I can probably bold these. Messed it up a little bit. Okay, so stock, additional paid in capital. And the retained earnings, those have all got to come off the books. if you think about it, for the subsidiary that we just bought, no one owns this, no one outside the company owns this stock. None of this is outstanding. Amy owns it all. The Amy company owns it all. So none of this is actually out there. The only stock for this that's owned by, that would have anything to do with this bill company is owned by whoever owns Amy company. So we're gonna take all of these off the books. Okay, so going all the way down here to the end, equity, we're gonna take it off the books with a debit. Okay, so 440. Oops. Okay, so this is all, what color do I want to make that? Yeah, let's make it green. So coming up here, we're going to take that out of our investment. Now our investment is a debit of 9,600. Here's the debit, 9,600. We're going to have to credit it. We want that investment to disappear. So we're going to credit that or whatever those came out to.
There is still a difference of 1440.
One more time.
1440 is the difference. Nine 9,600.
It'll eventually be that. It's not that. Yeah. So yeah, we're gonna take the side, but when we do we're also gonna do assets, and I'll do that in a second. So what do those equal though?
$8,160.
Okay, so we've taken the stack off. And you're absolutely right, though. We don't have enough taken off. We don't have 9,600 yet. So we still got one more thing we're gonna do, and that is these assets. Now, these assets, we have to put these on the books. Notice everything is on here at book value. So we're gonna put these on at fair value, which is what we paid for them. And I think the first one was inventory. 240. And we do assets, we have land, which was 480. It does equal out to this. Oops, so that's 720. Yeah, let's make that a color, but I think turquoise. Let me do turquoise. Okay. I will leave it. Okay, so what is that? 14.
1440.
1440.
Now the entry is equal.
Okay, yeah, so this is, so what we're going to do now is take all the cash and add it together. $2,400 plus 960. $360. $80 plus 720. 600. Now, so here we're gonna put the inventory on our book value, Bill's company book value plus the excess, excuse me, the excess asset of their inventory, which is, we think their inventory is 240. How much? Oh, yeah. So we're gonna add that to the 6720. Where that comes out to. That's 10,800. And we're gonna smash the land together with that. $81.60. By the way, chapter 3, I send these out in Excel files too, if you want to use them. Although there's a big advantage doing it by hand, which I don't think I've talked about here. What'd you come up with? 8640? Sure. Oh. There we go. And this one, there's no additional assets. 5760. Oops. And this should be 0. 9, it is 9, yeah, this is 0. And that's what we want to take it off the books. And so this will be our total assets. Okay, there we go. That should not be, that should be a comma.
$40,000.
4320. Okay. And we gotta do the same thing down here.
456.
These will just be these numbers right here. The only thing that's gonna be left are the equity section for Amy Company. These are all gone because there's actually no one outside the company owns those. Those are not outstanding shares of stock. These are outstanding. And the Amy Company stuff is outstanding. These are not outstanding. No one owns that other than Amy Company. Okay, so this should hopefully come out too. It does? Yay. So the only equity section that's left is going to be Amy's. Bill's is no longer out there. No one owns Bill's stock other than Amy Company, and it's included in whoever owns Amy Company. And so this is what a consolidated financial statement would look like. Now, actually, it would look like this. When you actually see a consolidated financial statement, it will just look like, these are all you're going to see are these totals. So a consolidated financial statement of Amy and Bill would just look like this over on the right-hand side. This would all disappear. These would be the totals. So when you see a company in their consolidated financial statement, this is what happens in the background. Let's take a break. Say be back at 7:05, 7:15. Yeah, actually, let me move this. Okay, so if you want to take a picture of that one. That's our first consolidated financial statement. And again, that investment account, we want to take that off completely because these, the consolidated totals all, don't do that. The consolidated totals all have that investment in there. I'm gonna go see who the, cognitive and behavioral therapy people that have in the room.
नहीं यार मेरा थोड़ा अलग है सब अलग है तो अलग नहीं है
One of the classes in here before us, they're in here till 5:59. I wonder who came up with that. 3:29 to 5:59. I've never heard of classes started like that. Okay, let's go. We'll do one more of these and yeah.
I have a question for you.
Mhm.
In problem 8, it says that cash was paid for the purchase,
Yeah,
then why is the adjustment to stock and retained earnings on the
because we bought,
when it's consolidated? Because those would have been generated, yet the company's not being dissolved,
right,
so the stock still exists,
it does,
and so does the.
but it's not
retained
but it's not outstanding. It's no longer outstanding. No one outside of Amy Company owns it. So yeah, there is still physically stock, and if they ever break this off and sell it in the future separately, that's the stock they'll sell. But
So then the cash is paid for it, but Bill's cash balance is not increased by the receipt of the $9,600.
no, whoever owned the company, they took the money, they handed over the stock, and they left.
Okay,
So at some point, it won't look like this one. It'll look like, it won't look like that one either. It'll look like this, except that, here's what the initial investment would have looked like for this one. Was 9,600, I think it was. So this would be the original journal entry. Whoever owned the company, whoever owned Bill would take this cash and leave. And they put this on the books, what they paid for it. So right when they purchased it, this is what they'd be on the books for. So at some point, Amy Company, well, actually, probably the day before, they had 9,600 more in their cash account than they had after it. But yeah, they paid cash for it, so it must have come out of that cash. I apologize for that. Come on. I turned into those old people that can't use a phone. How does this thing work? All right, yeah, so at some point they would put, they had to pay the cash out. And they have the journal entry, and that's how this investment account would be on the books. Now, notice before they do the consolidation, this is what would be on Amy's books, just this over here. That's the only thing that would be on Amy's books before the consolidation. And by the way, these consolidating entries, these are on the books just to do the consolidation, the total, and then they're taken off. Because these are two separate companies. But if they own more than 50% of the other company, they have to consolidate because they control the company. If you control the company, you have to consolidate the financial statements. In this case, they will have 100% of it, so they can, 100% of it they're controlling. And Yeah, so you will put the amount that they control on the books. And so, that's why we do the consolidation. Whereas we just, these investment accounts, will we counted twice if we don't eliminate them. But yeah, you're actually right. There is the stock still exists, but it's owned by the Amy company. No one else, there's no one outside, no external owners have this. Whereas this, whoever owns Amy company owns everything in Amy company, including the shares of stock of Bill company. But those shares of stock are basically, that there's no one outside that owns those. And by the way, one reason why they might keep it separate is to spin it off, to sell it out again, We're gonna buy this company, get it turned around, and then see if we can sell it. So we're gonna take off the assets and the stock, and this is what we do, if you're to do this immediately after. Okay, let's go on to number 9. I think number 9 is a little more. I don't know, my spacing on this thing is so weird. I don't remember it not being this. I just worked on this. Okay, let's see. I have excess assets. Okay, we have bill company, we have excess assets. Let's see. 4,000, 4,000, 3,000. Inventory looks like it needs an additional. Thousand? Is that right? Inventory, 16,000, we got 70,000, so. Is this how you did this? I think, actually, I don't think I had that there, did I? Yeah. Okay. Land's on the book for 14,000. It's on the book for 12,000 here. Man, does that not look right? You guys have the same numbers on yours? All right, this would be bad. This would be negative excess assets. No, you're right.
Minus 12,000.
Equals
No,
2,000.
we are right. We just have to do deduction, so.
Yeah. I'm all
Yeah.
upset about that.
12,000.
Yeah. All right. Okay, 12,000 minus, oops. Minus
Oh.
9
9,000,
equals 3,000.
3.
Okay, I'm going to. Oh, calculate how much is paid for goodwill. All right. So these are the excess assets. So identified at fair value, we have these accounts payable. Fair value is 18,000. Yep. Okay, so and the cash price paid was 42,400. We call that consideration sometimes. And so that would mean we have goodwill of. Yep. The unidentified assets. 2,400. Now, notice something that we paid 42,400. It includes that goodwill. So this 42,400 goodwill is in there. That's one of the assets in there. Excuse me. Okay. Let's do our eliminations. All right, let's see, stocks, we gotta get rid of the stocks. Okay, so we're getting rid of, hey. Don't. You guys learned in class today. Mr. Taylor doesn't know how to use a computer. Okay, it's still, I don't care, I'm gonna leave it. Okay, so 6,000 has gotta come out of our common stock. Our 15,000 has to come out of our additional paid in capital, our APIC. And 13,000 has to come out of the retained earnings. Okay, so we're gonna take that out of our investment. Oops. Oops. What is that, 21, 24, 40, 34? So 34,000, and we got rid of the equity section. And if you think about this, this stuff doesn't really exist. There's no outstanding stock. I mean, we have it as part of our ownership of the company, but it has no one outside the company. There's none of this is issued. And we now have to do our assets, so we have inventory, land and building. Inventory, land and building. Thousand. 2,000. And 3,000. And we have one more asset. I'm missing an asset. What is it? Yep. Goodwill. We're gonna put goodwill on the books now. And it was for 2,400. It's an asset. And now we're gonna show it separately from the investment account as an asset. Six, 8,400. 8,400 plus, yeah, that works out. Okay. So this is for this one, so we do have to calculate goodwill if we're doing these consolidations because it will go on the books. And I think I mentioned before, goodwill can only be purchased. It cannot be generated inside the company. So if you're wondering why Bill Company doesn't have 2,400 sitting on their books, it's because they can't. Only when you buy another company can you have goodwill, not when you develop it yourself. All right. Ooh, these numbers are a lot easier to add. I like this problem better. 20 plus 16 is what, 34 or 44? 45? 34, 36. No, 34. $36,000. Stop me if I write something stupid up here. Throw a shoe at me or something. All right, 16 plus 8 is 24. Oh, wait. Ooh. I almost missed one. Goodwill. $170,400.
Yes, it's correct.
That's correct. Okay. Yeah, thank you. Oops. And down here, again, this common stock, the only thing that's left is going to be Amy Company. Because there is no Bill Company stock outstanding. It does, it goes good. So I'll tell you something that there is sort of a way you can kind of check your answer a little bit on these. And that is if you take the you may be looking at this saying, okay, how come we have 152,400? Bill company, and we have 52,000, excuse me, of AIM company at 52,000. We have them together. How come it doesn't come out to 200 and whatever thousand? Actually, if you add those two together and subtract out the equity from the subsidiary, it should come out to the 170. Does it?
Yes.
You'd have to say that in class earlier, right? I don't blame you a bit. All right. Yeah, but yeah, so and if you think about it, the only thing that changed down here, was we took out the stock. So if these two sides are balancing, if you just take the stock out, it should be same thing up here. Take the total last, minus the stock. It should be the same. Okay, we're gonna stop here. I'm just gonna give you a heads up though for next class. We'll start it on chapter 3. Did I send out the chapter 3? I think I did. I'll send it out again next week. So next week, we're gonna see what happens when we, after we do the consolidation. What happens after they've been out working, for a year or whatever. They're doing that. I used to like Word when it wasn't helpful. It was so much more helpful when it wasn't helpful. Okay, so next week we're going to do the dividends, income, and additional expenses. That's the depreciation and whatever for the additional assets. So we'll start these on chapter 3. As you can kind of tell, these, even just doing the stock and the excess assets takes a few minutes. So we can actually spend quite a bit of time on these. So they're going to be a little bit of a slog, but it's good stuff. And so we're done with the chapter 2 handout. You can turn that in. Let me make sure I'm not lying to you. Got a bad request. Okay, here we go. Make sure there's a place to turn it in. Yep, you can turn in so you can turn in the chapter 2 handout. And I should have the grades up to date. And if you see if you can turn the chapter 1 exam in by Friday. If you can do that, I can put all the grades in. If I get most of those in. So anyway, yeah, any questions? Okay, I think I've had enough. Have you guys had enough?
Thank you, Professor.
All right, see you guys. I'll see you guys next week, and we'll start it on chapter 3 next week.
Appreciate it, Professor. Have a good night.
Have a good night. Bye-bye.
Thank you. Have a good night.
Bye.
Good
Good
night.
night, Professor.
Good night. Thank you.
Thanks.